Could we be on the verge of a trade war between Canada and the US? If these tariffs go through, they could shake up our economy, force the Bank of Canada into a tough decision, and hit our already struggling real estate market even harder. In this video, I'm breaking down which industries and cities would take the biggest hit, how this could impact home prices, and more importantly, what this means for you if you're planning to buy or sell a home. If you're new here, my name is Jessie McClellan and I'm a realtor here in Oshawa, Ontario. I make videos to give you a clear, unfiltered look at our local real estate market, what's actually happening, and what it means for buyers and sellers. My goal is to help you make informed decisions when the time is right for you. If you find this helpful, please like this video and consider subscribing to stay up to date on everything happening. So if the US moves forward with its plan, it would impose a 25% tariff on all Canadian non-energy exports and a 10% tariff on Canadian energy exports to the United States. This would hurt industries like the auto manufacturing industry, construction, energy, agriculture, and more, leaving them more likely to see job layoffs. I found this page from the Canadian Chamber of Commerce website that has some great information and graphs on the most exposed cities in Canada. For this chart, the cities that are higher up have local economies that are more dependent on selling goods to the US, and the cities that are further to the right have a larger percentage of their total exports go to the US. So for example, cities like Windsor, Calgary, and St. John, these areas are highly dependent on US trade as a large part of their economy relies on selling goods to the US, and most of what they export goes there. These cities would feel the largest impact. But cities like Barrie, Peterborough, and where I am in Oshawa, they send a high percentage of their exports to the US, but these exports are not as big of a driver for their overall economies. This next table is a bit clearer. The higher ranked cities in red and orange are cities that are highly dependent on US trade, and these cities would feel the biggest impact. And the lower you go on the chart, the more balanced and less dependent the cities are on trading with their neighbors south of the border. These cities are all exposed through different industries. St. John, New Brunswick is home to the Irving Oil Refinery, which more than 80% of its oil is exported south of the border, leaving it the most vulnerable city in Canada, according to this data. Calgary is also a major exporter of oil alongside natural gas and beef, leaving it the second on the list. Southwestern Ontario has many cities that manufacture cars, machinery, and automotive parts, so areas like Windsor, Kitchener-Waterloo, Guelph, and Brantford are also vulnerable. According to the article, the most recent data for Oshawa was from 2021, when our exports were significantly reduced because of plant shutdowns and production delays that came during COVID. We are certainly more diversified than we used to be, but because of General Motors, automotive manufacturing is still a major industry here, so there's an argument to be made that it should be a little bit higher on this list. Hamilton, being the steel capital of Canada, is also exposed as they export steel that's used in many different industries like auto production and construction. From coast to coast, there are cities that will all feel some sort of economic impact, some more than others. But it's not just the US tariffs we have to worry about. If the US follows through, Canada is likely to impose retaliatory tariffs as well. And considering over 60% of the imported goods came from the United States last year, it's safe to say those will have a fairly significant impact on Canadians and the economy here. This is where the Bank of Canada finds itself in a dilemma and possibly forced to make a decision that is lose-lose for Canadians and our economy. The Bank of Canada has been fighting inflation hard, increasing interest rates rapidly to get inflation under control, and now slowly cutting the interest rate over the last 8 months or so as inflation has eased. But a trade war between the US and Canada would cause an increase in the cost of goods across the border, and inflation could become a major problem again. If we see the cost of goods rise, but also see the economy slow down due to job losses and lower demand, we could see stagflation, high inflation, and an economic slowdown at the same time. This would leave the Bank of Canada to choose between raising interest rates and fighting inflation, or stimulating growth in the economy and cutting rates. Essentially, it's a lose-lose situation. According to the Bank of Canada Governor Tiff Macklem, he warned that the Canadian economy will not quickly recover like it did post-pandemic, and that if tariffs are long-lasting, there won't be a bounce back in growth, and the economy could be wiped out for 2025 and 2026. It sounds like if the Bank of Canada is forced to choose between stimulating stimulating the economy and keeping inflation under control, they will choose to continue to fight against inflation, which could mean interest rates going back up. According to a report from Scotiabank Economics, if Canada retaliates with their own tariffs, that could cause up to a 3% increase in interest rates. So that leaves us with, how would this impact our real estate market? Well, real estate markets across Canada are already off to a slower start in 2025. January in Durham region and the Greater Toronto area, we saw sellers return to the market very quickly and at a faster rate than we've seen in many years. But what's different this year than, say, 2021 or 2022 is that sales are not picking back up. So we're seeing inventory build early and at a faster pace than we've seen in recent years. And it's not just Toronto. Vancouver is also experiencing a balanced market with rising inventory levels. Some of what we're seeing is already caused by economic uncertainty. There's no clear direction of where we're headed, what's going to happen with interest rates, what's going to happen with home prices, what's going to happen with layoffs and the unemployment rate. When there's all of these questions, if people don't have to move, they often hold off and wait for the dust to settle. So the tariffs, in a way, are already impacting our housing market before they've even come into effect. Then there's the higher cost of goods, potentially higher interest rates and higher unemployment from job layoffs, all of which will only contribute to our market slowing down even further and would limit home buyers' ability to qualify. This could further boost the trend we're already seeing, and that's lots of homes coming up for sale, but not as many buyers coming back to the market. If we head into the spring market and this trend continues, our inventory levels will continue to rise and sellers may not see the bump in spring activity that they're hoping for. If all of that happens and we start seeing job layoffs, rising costs of goods, or especially interest rates rising, then that will definitely put more downward pressure on home prices because buyers' budgets will be directly impacted by those things. And that's just something that we could see in the short term and taking into consideration the resale side of the real estate market. But the new construction side of the market has already been having a tough time. New home prices, as they are now, makes it harder for buyers to justify because they're generally much more expensive than a comparable resale property. Many condo projects in the GTA are aimed at investors, but with recent market conditions, investors have been pulling back, and that's leaving many projects going unsold. But if we see steel and construction costs rise, that would mean new home prices would increase as well, and we would likely see less projects being planned and many of them being canceled. This is by no means a comprehensive look at all of the possible economic ramifications, but it's pretty crazy to think about the ripple effect this can have through the economy. Less homes being built means less jobs and more layoffs. It also means less money being spent on things like home furnishings and renovations that can result in more businesses closing and jobs lost. Then there's the fact that lower transactions means less revenue being collected from land transfer taxes, which municipalities all rely on, so we could see cities having issues with their annual budgets if they were forecasting more money being collected from those taxes. So there's many ways that this could impact our economy and also our real estate markets across the country, but it will really come down to if and when these tariffs come into effect and ultimately how long they stay in place that will determine how severely this impacts us here in Canada. I'd love to know your thoughts on this subject, or if you think there are other important factors to consider, please leave me a comment below. If you'd like to stay up to date on everything happening in our real estate market, especially here in Durham region and the GTA, then subscribe to the channel. Please hit that like button too if you enjoyed it, because it helps me reach more people like you. Thank you for watching until the end, and I'll see you in the next one next week. Bye!